customer of CMG's and of this program. I've had nothing but all-in-one loan mortgages on two properties that I've owned and own today since we put it to market. This is a program we introduced in 2005. We actually introduced it first to the market under a different brand name. We used to actually call it the Home Ownership Accelerator, and loosely people started to call it the accelerated mortgage. And we essentially kind of created a different category. We're the first lender in the United States to push forward this type of way to finance and pay for real estate. But it's not a new concept. It's really built foundationally from very similar programs that have been offered around the world for a very long time, to include Canada, all throughout Western Europe, Australia, New Zealand, India, Japan. Most of the world's largest banks offer very similar programs, and they're known as, they go by different names: offset mortgages, universal accounts. Even in commercial banking here in the US, this concept is utilized widely, very broadly with big business, and also private banking. It's so practical. It's so practical that it's sort of, yes, it's a mortgage, but it sort of solves the rigidity, the cumbersomeness, the expense that comes with owing a mortgage. So it's not just a loan, it's sort of a solution to the loan itself. Most people don't want to be in debt for longer, for more than they have to. And, traditional financing really doesn't solve for that. We all wish we had more resources available, greater liquidity, greater control of our trajectory financially, trying to save more, trying to reduce our costs, trying to position ourselves so that we can handle financial, challenges, and also retire securely, one day. The mortgage plays a large role in all this, and that's really, where I'm going to begin here. But briefly, if you're not already familiar with CMG Home Loans, just a very brief understanding and overview of who we are. CMG stands for Christopher Matthew George. Christopher George is our founder, our president. We're a family-owned and operated independent mortgage banking firm, one of the largest in the nation, over 30 years old now. And we're headquartered. Our national headquarters is in East Bay, San Francisco, San Ramon, and we maintain over 200 offices nationwide, employ over 2,000 team members within those offices and operation centers. But being privately held has really allowed us to think independently, to think progressively in what it is that we do. Yes, we provide financing to qualified customers, but our level of responsibility and the industry's responsibility, frankly, goes further. It's deeper than that. We should be focused, in our view, and I'm speaking for the company. The industry should also be as focused as they are with helping people obtain financing, as helping people better navigate and get out from underneath that debt load. And that's very important to us. We feel that if we can help people sort of accelerate and really kind of get rid of their mortgage debt, or have an easier time controlling it and reducing the cost, then that reduces the financial friction that comes with owing long-term debt, right? And the cost associated with that. That strengthens our housing market. It strengthens people's personal financial well-being. And, our belief system is that conventional product that is sort of put in place, mortgages that are sort of put in place as a one-size-fits-all, is really the wrong direction, really kind of the wrong approach. People should be able to customize and tailor the results relative to their needs along the way. And frankly, as we know, home ownership typically occurs during the busiest, most expensive, probably most chaotic period of our lives. We know that most people need to borrow money in order to make this happen, right? To participate with home ownership and housing in general. It's sort of a necessary evil. We also know that borrowing money costs money. And the typical influencer driver of decision making, at least in our world, in the mortgage world, tends to be interest rates, without question. We know how that works. Interest rates rise, and the demand for home buying reduces, and a lot of times because it creates uncertainty, and mortgage interest rates rising, is just reflective of everything else, the cost of living that has risen, right? Inflation, this omnipresent sort of invisible force. that erodes our dollar, our buying power. Interest rates fall. We also know what happens. We see people recycle their mortgage debt pretty routinely, about every 5 years historically, and they typically use the same loan they refinanced out of. So people sort of reacquire the same property multiple times. Oftentimes, as you guys know, people will put in place 30, 60, 90 years worth of mortgage debt right in the course of just call it 10 years, and make very little gains or progress on pay down and creating greater benefit or affordability. Again, because we rely on interest rates to do that. Um, to offset costs, what people typically do is they prolong their payment terms, right? Most people in the United States will choose the lengthiest term available, a 30-year fixed mortgage. I guarantee if we offered as an industry a 100-year mortgage, people would flock to that. Now, of course, I understand the benefit. The benefit is that it reduces the payment, the monthly payment obligation. But sort of along the way, over the last, call it 90 years, since conventional mortgages were put in place during the Great Depression, we've changed in our behavior. We've changed in our needs as a market, as a society. It was believed at one point or another back then that people would work for about 30 years and then exit the labor force and be able to retire. And that's why the 30-year loan was developed and put to market. Nowadays, we recycle that debt pretty routinely, and most people entering the retirement era, actually have a mortgage. 6 out of 10 baby boomers in the United States with a home still owe a mortgage on that home. The vast majority of mortgage debt outstanding belongs to middle-aged people, Gen Xers specifically. Millennials, what's even scarier is that the millennial generation, younger people, are actually their level of debt that they manage and have committed to is accelerated to the point to where it almost matches the level of debt that Gen Xers, who have had more time to accumulate debt, it almost matches that debt level. So to us, sort of, we're headed in the wrong direction. More and more and more debt, and somebody ought to come along and figure out, is there a way we can expedite this and make it easier for people to minimize that debt load and the cost associated with it? Today, Americans owe collectively, nearly $13 trillion on their home loans. And that's not reducing at all. Despite the fact that interest rates were low and money was cheaper for many years, people took on more debt. As a measure of this path, we also look at retirement security or insecurity, and there's plenty of government think tanks that look at this. Are Americans that are in the labor force that are working, pre-retirement aged Americans, are they on track to be able to live securely during their retirement years? The answer is about half of working households are not. And that could lead to some, to a lot of people living in poverty and even exiting the housing market altogether just to be able to survive. Again, that's another telltale that indicates we're not necessarily offering or going as far as we should with financial tools we call a mortgage. The pros are obvious. The benefits of traditional financing for real estate is obvious. They're sort of commoditized. There's not much information or education that has to go into learning how to make a payment. People are familiar with them already. They're readily available: 30-year fixed, 15-year loans, 5/1 ARMs, conventional product. They offer some payment dependability, right? They're structured repayment plans. Understand that the cons, the downside of traditional financing is also pretty obvious, but I don't think it's illuminated to people as routinely as it should be. The way we finance and pay for real estate is a slow method, right? The products are designed to be that way: slow repayment over many, many years, because they actually utilize our payment money every month. Our payment money is used inefficiently. Whereas most of our money goes to impact interest cost, predetermined interest cost, rather than our principal that we owed. They're rigid. Mortgages are one-way instruments, financial tools. Gosh, even a 401k account can be liquidated, right? If somebody needs to gain access to their money in case, right? A mortgage cannot be liquidated. You've got to sell your home or refinance, or maybe get a second lien on a property. So they're illiquid financial tools. And that leads to an expense, because the incentive to pay down a balance is non-existent. We're sort of disincentivized to try to pay down ahead of schedule. Less than 4% of Americans prepay a mortgage with any extra money at all. So of all the money we spend, servicing our debts on a household level, the mortgage is the greatest statistical expense we commit to. It accounts for nearly 50%, 40, 42, 43% of all that money spent on our debts at the household level. And obviously a huge component of that, or big part of that, is the interest charged to customers during their loan's term. This is our focus with the all-in-one loan. This is what we're solving for. Let me give you a quick example of that mortgage expense, even with a lower interest rate than today's level rates. Here I'm using 6% borrowed and repaid over 30 years with any loan amount. It could be a $100,000 loan amount or $1 million. It doesn't matter. What matters here is really the interest rate and the time somebody is going to take to repay the balance. In this scenario at 6%, which relatively speaking is a good rate, right? If rates came down to 6%, it would probably stir up some activity and people would be motivated to maybe sell and buy, right? Because it's lower than they are currently. But even then, the customer would be subject to paying more interest on that loan than they actually need to borrow. Even a 3% interest rate, which I'm not displaying, charges about 55% relative to the principal. So in other words, for every $100,000 borrowed at 3 or 3.5%, the customer still pays out roughly $55,000 in interest cost. So even low rate loans cost high amounts of interest. And that's, again, something we're trying to fix, and we do fix with the all-in-one loan for a suitable customer. The amortization schedule built into conventional financing is pretty obvious. We see it on our closing documents. Every customer sees it. Here's the amount of interest you're paying. Here's how that's amortized out over time, and most of that's going to be paid for up front, right? Delaying principal reduction, and this is what's wrong in our view with traditional financing for a large community of our customers across the nation. So rethinking the mortgage really starts with breaking down the equation. Every financial tool is just a mathematical equation, from home loans to investment accounts. Whether we're trying to grow the value of money, right, in an asset, or we're trying to reduce the cost of borrowed money in a loan, there's only three variables at play: interest rate, the principal balance, and the amount of time we're involved with that financial tool leads to the cost or the value. In terms of a loan, we know that most people are influenced by interest rate. Interest rate matters, I would say, arguably the most on a conventional loan, because the repayment of principal is amortized. It's predetermined and scheduled out. Whereas that might seem comfortable and affordable and even safe, it's proven not to be safe, and it's exceptionally expensive. So we say, let's change the focus of a mortgage. Let's change the focus of how money is actually applied. Instead of interest first, let's attack principal first. Why can't we? There's no law that says a lender cannot build a mortgage and offer it to the public that simply applies their money directly to loan principal first before interest is even computed. This begins to offset rates, paying a rate, whether it's 3% or 6% or even 7%. Focusing on principal reduction helps offset the cost of a loan and the negative impact that interest rates cause, right, on our wallet. It also reduces the time in debt. By reducing the time in debt, that creates greater opportunity for people to be more aggressive with their savings needs and funding other financial goals earlier in their life. So that's our focus with the all-in-one loan. It reduces the monthly, annual, and total interest costs without depending on interest rates. Interest rates could be lower or higher, like they are currently. The rate on the all-in-one loan is actually reducing pretty quickly right now. But rate matters less with an all-in-one loan because of the way it uses money. And in doing so, it builds equity in a property. It pays down the balance, and it builds equity in a property on average about 2 to 4 times faster than a traditional loan. And it does this without forcing a changed, expense level or budgetary change in somebody's life. No disruption of their lifestyle. It also provides access to equity money. It's what we call an open-end mortgage, not a closed-end mortgage. Not closed end is one way. Money only goes into it, can't pull it back out. We think that disincentivizes people. Uh, and we wanted to build on the incentive of gaining greater control of their cost by keeping their money liquid. So the all-in-one loan is a loan that allows somebody to put money towards it to pay down and build equity in their real estate and avoid some interest, reduce their payments, but also keep that money liquid over the entire term, which is 30 years on this loan, right? So it's a safe way, an effective way that builds that incentive to gain greater control. Now, the structure of the all-in-one loan is very simple, and this is kind of where the paradigm shift in our minds begins to occur. This is as elementary as I can put it on screen here. We call it the all-in-one loan because what it does is it merges together the mortgage, the home financing. I'll go through those terms here in just a moment, but the mortgage, the financing somebody needs, right? A qualified customer needs to buy and own real estate. You can also use this for a refinance. We merge the mortgage with personal banking. And when I say personal banking, I mean a actual FDIC insured, fraud protected, fully federally regulated and transactional checking account, a regular personal checking account, complete with ATM debit Visa cards that are issued, checks, check writing, online bill pay, mobile banking, mobile deposit, mobile. You can image a check to get money into it. You can ACH, and transfer money from any external account. You can link any external account to this, including business accounts. Fraud protection, customer service. That's really white glove. Everything a traditional checking account comes with. This is a full feature checking account, routing number, account number, but it has a couple added features into it. But I want you to understand that this is the platform. An all-in-one loan means that it's a mortgage platform that includes personal banking accessibility and features integrated into one financial tool, very fluid, easy to use product to provide financing for real estate, but also it creates this automatic engagement, this relationship between income and our debt. And let me describe why. Checking accounts are a very powerful tool. Not a lot of people, I think, walk around thinking about their checking account in those terms, but they are. Checking accounts tend to be the very first place our income lands. We work, we get paid, it goes somewhere so that we can use it. And it typically goes to a personal checking account. And that's where we spend our money from: groceries, utility bills, all the stuff we have to pay for. It's sort of the birthplace to net worth because that's where it lands first, right? Our income check. What people don't realize, I think, is that it's also a high volume account. It sees more money. The regular American, the regular working American who has a home with a mortgage will manage more money in their checking account over the course of the next 5 years of their life in aggregate than the total amount that they owe on their mortgage today. So just in 5 years, we earn enough and manage enough money in our checking accounts to pay off our mortgage. Now, of course, we have expenses and other things to pay for. So a lot of us can't do that in just 5 years, but maybe that same person could probably do it in 12 years and not 30 years. If only those dollars could actually go to work for them. And that's a key factor. I think what a lot of people also don't really realize is that a lot of their money spends a lot of time loitering in their checking accounts, waiting to be spent, right? There's always an account balance typically for somebody that can qualify or has a mortgage already and is established in their behavior. They always typically have a balance in their account. Banks know this, and I'm not faulting banks. That's their business model, right? They like the fact that there's a daily balance they can use as leverage to go make loans out of and generate income for the bank. That's their business model. But does that really serve us, right? Regular consumers, regular people, the most, right? Are we benefiting from our money on a daily basis more than our banks are? The answer is no. It's a valuable resource that tends to sit there waiting to be spent tomorrow or this coming weekend or next, during Christmas or the holidays and maybe tax season. So a lot of our money tends to loiter around for sometimes days, maybe even weeks, sometimes even months, right, in a checking account or low interest bearing savings account. And all that money, right, on a daily basis pays us less interest than the amount of interest we have to pay out on our debt. We always earn less on our income than we have to pay on the debt. that we fund through our income. And this is the adverse relationship that exists in the regular way we do things. And this is what we break down with an all-in-one loan. We say, hold on a minute. Big business get to use their money, their capital more efficiently. Homeowners in other countries, other parts of the world get to use their money, their income more efficiently. We should build a mortgage product that mirrors those benefits and allows money to go to work for people the day it's earned to help them shrink the size and the cost of their mortgage debt. After all, it is the biggest expense we commit to. Let's try to get rid of it sooner. Let's help people strengthen their financial well-being through an innovative mortgage program that's really practical. And here's the way it works. The checking account, the all-in-one loan checking account that comes with the mortgage, when we close this loan, 30, 45 days later, the account is activated and a checking account is created for our customer, and they receive all the checking accounts. It feels like when you get an all-in-one loan, it feels like much more like you just open up a brand new checking account and it comes automatically with the financing. That's the checking account is how our customers engage their mortgage. Engaging their mortgage is accomplished through the checking account features. And it has a special feature built into it called sweep banking. Sweep just means transfer, automatic transfer. So here's how it works. When a deposit is received, whether that deposit is $1, $10, $1,000, maybe it's $10,000, maybe it's $100,000, doesn't matter. Whatever is deposited on that particular day, that money doesn't reside there past 11:59 p.m. The checking account moves that money automatically, securely, directly to the mortgage, paying down the principal balance by that deposit that day. So it's called a daily sweep or sweep banking. Imagine depositing money in your checking account and your mortgage balance drops that same day by that amount. And the benefit here by doing so is automatic. You're developing equity in the property. That money deposited is a payment towards principal. Keeps this construct keeps that money liquid for use each and every single day, 24/7. But in the meantime, it's converted to home equity dollars made available through the mortgage. The benefit here is that interest on the all-in-one loan recalculates daily after any sweep occurs. So if money was deposited today with my all-in-one loan, my mortgage balance drops today. Right after that sweep occurs at 11:59 p.m., at midnight, it recomputes interest, today's interest. So we're not predetermining interest cost over 30 years. We're saying, hey, we want our customers to have full control of their principal balance to make greater progress on daily reduction, keeping it as low as they can on a daily basis, because that's what we're going to compute monthly interest cost on is their daily interest, their daily balance. That's just simply the nightly principal balance times the rate divided by 365 days in the calendar year equals today's interest cost. Pretty simple. Tomorrow, it'll do the same thing. Whatever my principal balance is on my all-in-one loan will recompute. And it does this every 24 hours automatically throughout a month, a single month. Let's take December. We know there's 31 days in December, so there'll be 31 days of interest that computes. And on January 1st, I'll be notified. All of our all-in-one loan customers will be notified, tens of thousands will be notified of their interest, their cumulative daily interest from the month of December, that total amount. And that total amount is the interest payment. That's it. And that interest payment isn't due until the 21st of the new month. So January 21st, my interest payment is due and will actually be drafted from my mortgage automatically for me. I don't have to lift a finger. It'll be drafted from the mortgage and that pays for December. And this is a really practical, brilliant, very convenient way to pay for the cost, but gain control, much greater influence over the daily cost, which accumulates and totals up to an interest payment. So the minimum payment on the all-in-one loan is the interest that from each day, paid once the month ends on the 21st of the new month. And the greatest thing about it, probably the most invigorating thing about having an all-in-one loan is that interest payment reduces monthly, ongoingly. The point is to drive the cost monthly and annually and in total to zero as fast as possible. Instead of having a static fixed payment for 30 years that never changes. Because think about that. As inflation takes hold like it has, our discretionary income reduces. The money we have left over reduces, right? Because the cost of living increases. So what good is a fixed payment that may be affordable but stays the same when the rest of life is getting more costly? Again, the greatest thing about this product is that it reduces the monthly overhead. The monthly obligation itself reduces too. It accelerates downward. So a payment that reduces monthly is better than a payment that is fixed and never changes. And that again, that's because of the activity of money washing in and out. Money remains available 24/7 for expense spending, just like normal. Pay your utility bill on the day that it's due, not earlier, and let money work daily to keep that daily principal balance lower for longer, right? So it really kind of creates this engagement factor, um, being proactive with a mortgage instead of just letting it be a ball and chain in your life forever. Now, the reason why it pays down is not just because the daily interest computation and the savings that creates, but also because there's naturally going to be money left over in the mortgage, and that would be money typically budgeted for a standard mortgage payment. So I don't have to make a P&I payment on a regular mortgage. Now, if my budget said, hey, you can afford $2,000 a month for that P&I payment, but instead I have an all-in-one loan, well, gosh, now that $2,000 just resides in my all-in-one loan. I don't have to spend it, right? If that's my budget, then I should be as comfortable keeping it with me. And if it's kept in the all-in-one loan, it continues to compound the savings and accelerate pay down. Plus money I just don't need by the end of the month to spend and support my lifestyle. I always typically have discretionary money left over. And this loan is intended for those people who do that, who operate that way, don't live beyond their means routinely. This allows that money to go to work and pay down faster. All the meanwhile keeping that money liquid. So it's an equity accelerator, principal reducer, interest saver, right? And I would add to that an opportunity gainer. It creates or a creator. It creates opportunity to better maneuver and navigate through life, be more mobile. I think that's what a lot of us like. We want to be more mobile, have more resources available. Now, all of this is possible because the mortgage side of the all-in-one loan is not our standard closed-end mortgage. It's an open-end mortgage. And that means technically it's a HELOC. It's a home equity line of credit. So the mortgage security, the all-in-one loan mortgage security is a first position home equity line of credit. It's actually a 30-year draw line of credit. There's no other mortgage product like it ever built in the United States. This is sort of the anti-mortgage mortgage. Lenders and banks don't want us to have access to our money for 30 full years. Why do we think that's appealing and valuable? Because it creates, greater optionality. Because we know we don't want to just put a mortgage in place for somebody and then chances are we're going to need to give them another one on that same property in another 3 to 5 years. That's very typical. That just keeps their cost high. Why not build a loan that they can utilize over the next, 15, 20, 30 years of their life fluidly, while it also is structured to help them sunset the debt safely and faster. And the way we achieve that is we begin to reduce the approved credit limit. So the credit limit is the loan amount on our all-in-one loan. Somebody can apply for an all-in-one loan for up to $4 million. And whatever that approved credit limit, that loan amount, that is going to begin to sunset after the 10th year evenly on a monthly basis. It's a 1/240th reduction of the monthly of the credit line. What that does is it achieves, liquidity. Means that somebody's got a line of credit. It's their mortgage. Regardless of where their balance is, the difference between their daily principal and that credit limit, given the structure all the way over throughout the 30-year term, is liquid to them. So that means that they can utilize it for other things. And that's really what's in it for us. If that question is beginning to stir up in your mind, what's in it for this, company? We learned and we understand that by putting a product like this out there, we reduce the likeliness that we'll lose customers. Again, we supply somebody with a standard mortgage. They're probably, at least statistically, going to do something with that mortgage and need another one in 5 to 7 years. Historically, that's supported. In this loan, we're basically providing borrowing needs all into one mortgage, future borrowing needs all into one mortgage, and it strengthens somebody's financial well-being along the way. We just don't lose customers on this loan. It's a stickier relationship. It also reduces risk. We have no defaults, no reported defaults or losses on this loan since day one, 2005. That's all the way through the financial crisis of 2008 and COVID. And so it's a high performing loan product for us, designed for people who are established in their financial behavior and you know how to budget and just do things well that way. They just need a head start or a kind of a cut in line, and get further more rapidly. I'm going to pivot now and kind of get into some of the resources available and some of the allowances, and then I'll button this up and open it up to any questions if you have them. And I know there's other things to cover on our meeting here, but one of the best resources outside of our team there locally, of course, is the public website. And this website's accessible through our team members' individual websites we call my sites. But on the allinOneLoan.com website, a ton of resources. One of the best features is the ability to forecast potential benefit. We do not put this loan in place unless there's obvious benefit. But boy, oh boy, is it impactful and clear and accurate when that forecast looks positive. So we call it our interactive simulator. It just looks like this. It's on the website. All of our interest rate terms and things like that are also publicly available on this, so people can really kind of kick the tires and find out if this is something that they could benefit from. We're just capturing, some minimal information, no personal information required. What do you owe? What's that? What do the terms look like? Or what kind of conventional mortgage are you considering getting? Maybe it's a new home purchase. So we want to compare the all-in-one loan to that. What do the inflows of money look like? And you can go deeper and deeper into the calculator to really build out a budget and forecast, even future deposits or inflows of money. Same thing with outflows, the spending. You can go all the way down and open up subscreens that allow you to really get a little bit more granular with a budget. Is there any money left over? What does that look like? It just dives into saying what's coming inbound, what's going outbound relative to the debt owed. And of course, then it's going to get to the results, and interest rates and interest rate assumptions can be changed. It goes deeper and deeper, a CSV file that breaks things down to the week, that side-by-side comparison. For any analytic that's listening, you'd love to look at that, but it measures effective rate of interest compared to that other loan, break-even rate, like where wouldn't this make sense, et cetera. But the benefits are very telling, and oftentimes we see hundreds of thousands of dollars in interest savings and clearly a faster payoff as a result. But again, that money's kept liquid for people to maneuver over time. Huge benefit. I'll just pass through some of our credit, allowances in our approach. This is a proprietary product that we balance sheet and also securitize. And it's serviced by a couple of our bank partners that are national banks. That's Merchants Bank of Indiana and North Point Bank, been partners of ours for a very long time. We approach this using agency standards, meaning Fannie Mae and Freddie Mac standards for underwriting, manually underwritten. But there's some nuance items that really make sense for good savers. Asset depletion allows us to use assets as income, and that really helps with self-employed people who otherwise may have a really challenging time with qualifying with conventional product. The variety of different things that are kind of wrapped up into this that make a lot of sense and help people qualify that doesn't increase the risk to them or to us. This is not a fixed rate mortgage because we don't want to fix the payment and we don't want to fix the cost. We want people to reduce their cost, right, and gain control of that and reduce their monthly payment obligation, drive it down to zero sooner in their life. So this is based on a rate structure in which the customer and us share in the rate cycles where we are aligned. Banks have a hard time when rates go up, but they have a balance sheet full of a bunch of loans they secured for people with lower rates. That's why banks and lenders begin to contract with their offering. We don't have that problem with this loan. We share in the risk and the benefit. The rate on this loan is driving downward right now, and the Fed hasn't even begun to move rates down. Why? Because of the index we use. It's the 1-year CMT, and its historic average is about 2%. There's a margin on top of that every customer has optionality, full range of margins that start at 2.5 and go up to 4% over that index. Gosh, the index was down at 0.6% during COVID. And I think it even drove a little bit lower than that. So this is an index that can move and it moves relative to the economy, but it's very predictable. Rates average, between about 7.6 to about 9.1 right now. So I would say comparable, maybe slightly higher, slightly than a traditional loan. But again, it's the effective rate of interest to an all-in-one loan customer. The most important question is this: What's most important to you? The interest rate that comes with your loan, or the amount of interest you have to pay on your loan, right? And if it's the latter that's most important, this then it deserves a greater discussion about better ways we can effectively reduce the cost associated with owing money, because interest rates are only 1/3 of that total equation. You have to worry about principal and time; those matter most. So this effectively reduces the cost, given the rate structure and the ability to use deposits to pay down principal. Another couple slides here just to illuminate, our basic credit allowances. We go up to $3 million in general, but I mentioned we can go to 4. We do that on our just an internal exception basis, just in case. That might have meaning to some of you. We also, for purchases and rate and term refinances, we can actually go to 90% loan to value, up to $1.5 million. So for somebody that's maybe bought their home just recently and maybe they only have 10% equity in their property, or they have a 10% down payment, we can fulfill that need with this product, but no higher. Second homes, great option for, vacation properties as well, to finance and pay it down faster. We lend up to $3 million. And obviously we do require good credit, decent credit scores. Investment properties. If any of you own investment properties or thinking about it, I can't think of a better way. Myself included. I've had the all-in-one loan for since the year we put it to market in 2005. I've used it to grow and purchase investment properties. And it's the greatest thing about that approach is that you're using rental income to pay down, deposited directly into the loan to pay down principal faster, which offsets or reduces the interest payments each month, which then grows the positive cash flow position for the owner of that property without having to increase rents and without relying on interest rates, reducing, because that just requires a refinance and then you're restarting the clock all over again. So this achieves greater positive cash flow in real estate owned without depending on all that stuff, and keeps money liquid over 30 years. So it makes it much easier for an owner of investment properties to repair, right, to renovate, to buy again, right, and continue to grow their portfolio. Second to the last slide, we are launching here between the day after tomorrow and the 1st or 2nd of January, a brand new term or feature on the all-in-one loan that'll fund construction, new construction, not a renovation loan, but new construction, ground up. So if any of you are interested, make sure you talk to our team out there. But it's imagine funding construction with a 30-year draw line of credit that is also your primary banking engine. So you're able to power down or pay down principal while the home's being funded and constructed from the mortgage itself. So that means that brand new home is constructed, our customer will owe less on their loan, and they still have access to a credit line that we approved initially in underwriting, and everything in between is liquid, so they can continue to build out and furnish their home or whatever, or continue to pay down aggressively. But it's certainly going to help people save money and probably be a lot more appealing as they take on that additional burden in their life. Instead of having a larger loan debt size at the end of construction, this helps them minimize it during construction. So very cool product. Last slide. My closing comments are this. This is a very, different product. Some of you may have already been introduced to this previously. I hope I've maybe illuminated additional ideas or another way to think about it, and hope you do take it seriously. It's a product that, we often hear from our customers, I love my all-in-one loan. I wish I had this 10 years ago. We hear that all the time. I'm not saying that this is a one size fits all. This is a product intended for people who do things well financially. They can budget. They don't spend more than they make. They've got a grip on those finances. But consolidating where they manage their income with the debt itself in one instrument could go further for them. And it's worth knowing about, worth considering seriously. So with that said, I'll wrap it up, and I do want to, and I'll stop sharing my screen, and I can answer any questions that you might have right now. Katie and Jim, was there anything else you wanted me to hit on that I didn't during that presentation?
I think that was great. One of the things I wanted to mention was a lot of people joined after we started. So the all-in-one loan, as you probably understand now, is the loan that's different from a conventional 30-year fixed. I believe we can couple this with the home fund it with some down payment assistance, correct?
Yeah,
So yeah,
routinely.
first time home buyers can use it. And we do have a program called Home Fund It that will help with down payment. So in January, we're going to do a down payment assistance webinar similar to this, and we'll talk more about that. But this is a good loan to understand if you're going to be in the housing market in the near future as an option. And I think what we're going to do now, Dave, is we're going to just talk to some of the folks that have joined us that have all-in-ones, are getting an all-in-one, and a wealth advisor who's going to share some of her thoughts on it.
Great.
And if anybody has
Feel
any
free
questions, we'll give it
to-
a minute or two, but
Yeah, feel free to raise your hand or type in the chat. I'm watching the chat and I can ask those questions for you.
yeah. There was one question, actually, gentleman Yehai asked, and I know Jim answered it, but I thought I'd put it out there so everybody heard it. Is the all-in-one loan mainly designed for conventional loan borrowers?
Yeah, great question. And Jim, I didn't read your response, but I guarantee it's 100% accurate.
99% accurate. I said it's 75% LTV for investment properties, but Aaron just emailed me that recently changed to 70.
It did, but we still, you saw it on the matrix I had on the screen there. We still do allow to 75%. We sort of have in certain areas, just with what we publish for our guidelines internally, as you guys know, have trimmed back in certain areas, but we still make exceptions. So just keep that in mind. We can still go to 75% on investment properties. And we'll probably republish here very soon with that 75% level. But that's something we can do. To answer the question, it really is. I would say yes, it is really designed for the individual who can qualify and manage a standard mortgage well, right? Because I would argue that it's not that easy to qualify. I mean, for some of us it is, but I mean, it's just qualifying for a mortgage and going through that process is not the easiest and greatest experience in your life. I think we do it better than most, if not all. But standard mortgages still are really intended for people who can budget and are disciplined enough to make that payment and not go delinquent and risk default, et cetera. That's really the building block or the foundation to the all-in-one loan. Take that customer, and instead of them committing their income, a huge percentage of their income over the next 5, 10, 15 years of their life towards a structured amortized payment in which is being consumed mostly by interest up front during that period of time. If they just took their same budget and they applied it to an all-in-one loan, all of that money that they flow through it is impacting daily principal, which offsets the amount of interest they got to pay each month. So I would say yes, it's really foundationally right. Our approach is the conventional mortgage borrower. However, the caveat is, and I think Jim referenced this, without the limitations, the geographic restrictions on loan amount. Right. So there are none with the all-in-one loan. We can lend to $4 million in Carnation, Washington, or San Diego, California. It's there's no geographic restrictions and nothing that is built into the product and optionality of the product that only one segment of people get versus the other. Everybody gets the same options. So it's sort of an easier loan, I think, for us. It takes more education. I find that invigorating. I think that helping people understand how they could go further, and it's sort of about empowering people, right, and illuminating that empowerment. But in terms of operationally, it's sort of an easier loan for us to close. Less steps involved, and easier to just get done and document and transact and underwrite. So hopefully that answers your question.
well, thanks, Dave, and thank you very much for your time. I'm going to zoom off here and ask Jennifer. She's in the process, Dave, of getting an all-in-one. I'm just going to ask her to share how the process does compare, because she just did a conventional purchase about 8 months ago and now is looking forward to getting an all-in-one. So go ahead, Jen.
You're on mute, Jen.
There we go. Hi, everybody. So I mean, so far, I guess for me, the process is almost identical. I haven't seen anything different. Process is never easy for me, as Jim and Katie are well aware. My loans have always been incredibly complicated, but it's mostly because I'm self-employed, and so the self-employment adds another layer of complication to the whole thing that has, definitely been a struggle on my end. But so what we're waiting for now is just for my next year of my W-2 and everything to align. But there's nothing different from how the regular mortgage process has gone. I mean, it's all the same documentation, it's all the same emails, it's all the same appraisal. Everything so far has been identical.
Can you tell us a little bit about why? I mean, you've been fairly determined to get the all-in-one since you started learning about it last summer. So can you tell us why?
Determined is one way to put it. I've been fairly obsessed with this loan since I heard about it. Primarily because I sit on the simulator sometimes in the evenings and I just keep playing with it and more conservative. Well, what if I decided to spend a little bit more money every year? What if we had a drop in income? What if we couldn't put as much into it as we always thought? And it's still, like Katie said, we just bought our house in March, and it's, if we had, we have had a very good year for my business, but I'm like, what if things slow down, if the economy does change? And it went from, we have a 30-year mortgage right now to all of a sudden we're paying our loan off. The first time I did it with putting exactly what we're making now, paying it off in 5.5 years. And I was like, this is not real. There's just no way that this is possible. This has to be fake. And so I keep kind of playing with it, okay, what if, talking to my financial advisor, what if we put more money away in a 401k versus kind of, the savings. And so now being a little bit more realistic about what if, every year we want to spend $40,000 of our home equity on a project. We want to redo our yard, or we want to paint the house, or we want to buy an investment property and we need to pull some money out for down payment. It shot up to 8.5 years. So it's like, okay, being realistic about it, I haven't had a bad simulator yet. I haven't had anything that tells me that my income is going to drop enough to where it's going to make a difference. And, the other thing about it for me being self-employed is that if we do have a slow year, I'm in the architecture and design industry and, things have been very good. People are building and they're wanting to do things, but that's probably not always going to be the case. I'm expecting that there's going to be a year where things slow down and, if they don't, great. But if they do, I want to be prepared for that. And one of the things that's really appealing about this is that, the equity can float me for a year if needed, or at least make up for that difference in income that I don't have for a little while. Because it's, it's not going to be 10 years that I don't have any income. It might be a few months where I have a slower time. And so the ability to have the mortgage just come directly out of the savings account has, just makes me feel so much better because, while I can save money, I love the idea of that savings applying to the mortgage. So it just keeps paying it down. So now I just have to wait until February. just sitting here waiting.
IRS announcement. You can file your taxes now.
Just waiting.
Jen, that's Jen. I was going to say something real quick. Your story is we hear commonly from so obviously being a portfolio, proprietary product, we monitor performance. Of course, that's extremely important to us. The whole idea behind the loan is to develop something and really educate people and inform people who could not only qualify but also benefit from it, right? And have success with it. And that's in our best interest to develop and stay diligent with that approach. Oftentimes we see people kind of forecast out, in the interactive simulator very conservatively, right? How their results might look. But in reality, after they get the loan, we often hear from people that they sort of gamify it, it makes you, it does, it's not required, but it makes you think differently. Like, I tell you what, why don't we not spend that $50 on Amazon right this moment? Nothing against Amazon or anybody that may work for, I'm just saying that, like, it gets you to start going, we're getting a tangible benefit by keeping our dollars against our mortgage principal, right now. Let's kind of think a little bit more diligent about where we're headed as a financial trajectory. And I think that's what's missing in personal finance. A lot of times most people walk around and don't really know where they're going to land, and this gives some visibility, especially as related to the debt, right? The biggest debt of your life. And so we often see people leave more money in it than they initially forecasted, a lot more money in it, and make faster gains. And so anyway, I'm happy that you're getting it and that you're going to find success with it. Yeah, it's awesome.
We won't be giving her your email, Dave. She won't be reaching out, I promise.
It's okay. I live and breathe this stuff too, so it's okay with me.
So, and then next I wanted to introduce Brian. Brian has graciously taken some time from his busy schedule as an engineer and owner of many rental properties to join us today and just kind of explain how it's helped him with his wealth and why he likes the all-in-one.
And I think, Brian, correct me if I'm wrong, but you have 3 of these, correct?
I do, yeah. My wife and I have 3 all-in-one loans, and I'll tell you about 2016, just to give you a quick story. My wife found this article about what is it called? It was called "Replace Your Mortgage" or something like that, and she shared the article with me. I was like, "Oh my gosh, why are we not doing this?" Because by 2016, we had 3 properties, 3 single-family homes, 3 conventional mortgages, and it just felt like we actually paid one of them off, but then it was like we have $400,000 in equity just sitting here. We can't do anything with it. Kind of just like Dave was saying, we were house rich, cash poor. And we wanted to figure out how can we scale our real estate business? How can we actually get into, like, how are all these other people doing this? How can people buy all these multifamily properties and have access to that? And when we found out about the all-in-one, I was like, wow, this is the #1 wealth building tool that we've put together, that we've actually been able to find to really scale our real estate property or our real estate business and actually be able to scale that wealth out. So what we've kind of done is we paid off one house and then we took out an all-in-one. So we had $400,000 in equity that we were able to pull out 90%. Well, at the time it was the house we were living in, so we pulled out 90% of that equity, and we used that to purchase a duplex. And then a couple of years later, we used the equity in that duplex, refinancing an all-in-one, and used that to purchase a fourplex. And then just recently, we took money out of the all-in-one to purchase a second home. Actually, we paid cash for an Airbnb that we bought in Scottsdale, and then we pulled out a third all-in-one loan to purchase a second home in Leavenworth. So it's been huge because prior to that, we were completely locked down. We didn't have any money. We were like, we have all this equity, but we can't do anything with it. What's the point? Plus, like Dave was talking about, with a conventional loan, it's completely front loaded. So you got this amortization schedule where you're paying all this interest up front, and it really doesn't make a whole lot of sense to make the extra mortgage payments because you're like, well, I don't have access to it. And like Jen was saying, both Tara and my wife and I, we both work at Boeing, and it's not the most stable company to work for. We've gone through a lot of layoffs. And with a large real estate portfolio, we have to have a $70,000 to $80,000 emergency fund. And keeping that money in cash, just because there's always something that's coming up. There's a $30,000 roof to be fixed, a $10,000 HVAC system replaced, whatever that is. So we keep that large amount. We put that in our HELOC, and I absolutely love the sweep account. I absolutely love that as soon as I put money, my paycheck, my rental checks, everything goes into the sweep account. It immediately goes and is paying down the average daily balance. And then we go and we pay our bills with our credit card, which gives us a little bit extra time to keep that money on the all-in-one. So despite the fact that, for years, I say over 40 years, the interest rates were gradually going down. Just recently, they've been going back up. But even despite the fact that we started out our all-in-one with about 3% interest, it's now around 9%. It really hasn't impacted us hardly at all. Yeah, the payments have gone up a little bit, but like Dave was saying, it's more about how you're managing the money and how you're making your payments. It's not so much about the interest rate. The interest rate really doesn't have that big of an effect. But my wife and I, we absolutely love this loan. I would get more if I could, but I will tell you, after 3, I don't really think it helps that much to get more. It's much more effective as long as you got 1 or 2 loans where you're putting all of that money into one space. But we've been able to leverage that with our rental properties to where we can actually, it makes more sense to have an extra loan. And as soon as you've got rental income coming in that's over and above the mortgage, it starts paying that down faster as well. So I will say it's not for everybody. Like Dave was saying, you've got to be responsible with your money. I mean, I'd love to go out and buy a $100,000 Porsche with it, but that'll make you go broke real quick. So my wife and I just made the agreement that we're just going to buy assets with the equity. As long as we continuously buy assets, it's like you're really able to scale that out, and it's been huge. Like I said, in 2016 we had 3 properties. Now in 2023 we have 8 properties and 15 units. So we never would have been able to do that without the all-in-one loan. We would have been stuck with a large amount of equity just sitting on the original property that we paid off. And we'd be kind of locked in. So it's been a
You'll get your
huge
Porsche someday.
wealth building tool for us.
Yeah.
Yeah.
We get that Porsche.
Yeah, eventually if we decide to sell but
Yeah, thank
also
you, Brian.
we're planning on using that to fund our kids' college as well. Our renters
Yeah,
are going to pay for the
absolutely.
kids' college. So
Yeah.
That's awesome.
Perfect.
If you don't mind, real quick, I think you hit it on the head here, Brian. It's what I think also what a lot of our customers over time, maybe don't really recognize is that this is you're in your peak earning years, right? The home ownership typically occurs during a period of time that where people approach where they live within their peak earning years, and that potential should be put to work to acquire more assets, because there will be a time or a period of time in which you need to depend on those assets to distribute some money off of to live with, right? And the home is a incredibly valuable asset to acquire, but only if you have equity available to draw from potentially during retirement. And that's often missed with the conventional way we approach financing real estate. You're not liquid, and you're not creating equity through pay down aggressively. The all-in-one loan accomplishes both those, right? Solves for both those things so they can be depended on if needed, and probably could be depended on as a plan A during retirement, so you're not pulling from other assets, because the greatest thing about real estate is you're not affecting its value when you draw from it, right, to live with or live from. Whereas other assets invested, you're impacting principal and therefore the value of that asset if you're distributing off retirement funds. And so it's sort of these extra conversation pieces that I think are incredibly valuable. So I really appreciate your insight and your experience and your story. Thank you for sharing.
Yeah, thanks, Brian. Thank you very much.
Mm-hmm.
I think next what I'd like to do is jump to Becky. She's a wealth advisor, and just have her share some thoughts. She's been doing a lot of research on the all-in-one. We've had lots of conversations and looking at different scenarios. So Becky, just tell us kind of what you think and how you see it working with people building their wealth.
Yeah, thanks, Katie. This has been great. That's it's really interesting to hear some other real world examples from Brian. I mean, and you guys are talking my language, where when you're in your peak earning years, you should be buying assets, building your wealth, and that's what it's all about. So, as far as what hasn't already been mentioned that I'm thinking of, you guys have emphasized really well that this is not for everybody. It's for a client, I would think of it with a client of mine that does have plenty of excess savings, in their current income stream. And somebody who is motivated to pay down their mortgage. Some people that is hard to maybe wrap their head around, right? Mm-hmm. But they're motivated to do it in a shorter amount of time. And you need a disciplined person that's on top of their expenses and they know what they're doing. And hopefully they're working with an advisor who is talking to them about their plan, their financial plan, and they have their goals, very well defined, and they're working towards those. So having all the appropriate language aside, I see this is something that just provides more liquidity. And in my business, the way I see it, liquidity is valuable. And it is it's an asset, it's a feature of an asset that I think gets overlooked a lot. So this is essentially a margin loan, the equivalent of a margin loan, but using your house as your asset. And we use margin loans in my business for clients that have a big expense that comes up. They can use their investment portfolio as collateral, and they don't have to sell their stocks and realize a taxable gain. That's the real big reason. This provides you just another avenue to do that. And I could see, and Katie and I were talking about this, getting ready, for the presentation. This, I think, makes sense for somebody who is getting ready to maybe try and retire early, and there's going to be a couple of gap years where there's some income that's coming down the road that they plan to replace, but they want to, it's just like what Jennifer was explaining. If she had a slow year, you're planning for a couple of slow years. This is something that could help you delay Social Security from full retirement age to the 70-year-old age. And that can significantly boost your Social Security income too at 70. I think that's something that most people can, really relate to. And paying for college. That's already been mentioned.
Yeah.
That's a big deal.
Yeah. And the Porsche.
Not the Porsche, Katie. That's a depleting asset.
Well, I'll give you another
appreciating.
I'll give you another stat. You know, the vast majority of the and thank you so much, Becky. I love your insight. The vast majority of mortgage debt owed, I think I mentioned maybe earlier, is owed by Gen Xers, and you know, that would make sense. You know, because this is the people that are most active in real estate that are living today, et cetera. But you know, I think it's often missed by people that debt load is going to counter your ability to actually retire on time or securely at one point. And you've got to solve for that. And, you know, much like Brian right now, where he's focused on acquiring assets, you know, not everybody thinks that way or has the ability to do that, right? But a lot of Gen Xers have kind of established their spending habits, and but they don't know why they're not making progress. They just don't. Maybe they don't have a Becky in their life, you know, or have not been introduced to an all-in-one loan, or don't understand it yet. But I think everybody, most of the people we serve today, these are very basic principles that aren't taught. You know, the financial literacy level is extremely low in the United States, and you know, it takes forums like this, I think, to kind of spread the message and help fortify. Because I think that what's going to happen is pretty dire. I think that there's what's at risk for a lot of people out there is that they'll find themselves living in poverty at poverty level potentially, right? And we're very near it during their golden ages, which should be fulfilling, right? And it's an unfortunate direction that it seems a lot of Americans are headed that are otherwise doing things well, conventionally speaking, you know, well enough. So anyway, I appreciate your comments. It's always illuminating with having a, you know, fiduciary, a holistic approach, you know, that kind of oversight, and incredibly powerful when this loan is in place for a customer who utilizes the guidance of an advisor without question. It performs even better.
Thank you. Yeah, that was great, Becky. I appreciate your input, and it's something I'm looking at as far as potentially putting off Social Security as long as possible. So yeah. I think we'll finish up here. We're going to give
with the reverse mortgage as well, potentially at some point down the road.
Yep. Well, I think we'll finish up here with Jim DeMarco.
Can I have one more question?
Sure. Yes, sure.
Yeah. So David, so I'm not sure like if how the all-in-one loans affect like in the future. If I have a couple all-in-one loans, I get continue to get a commercial loans. How all-in-one loans gonna affect the future lender to do the underwriting sort of things? Basically, will all-in-one loans like give some ambiguity for other lender to evaluate my financial, my assets, my loans, sort of like that?
Are you talking about the actual daily use of it?
I think he's talking about maybe the debt load of it in future qualifications for other conventional loans.
Yeah, great question. Yeah, super. Got it. Yeah. So I really can't speak for, you know, other lenders and other product line. Typically, so what reports on your credit with an all-in-one loan is that it's a mortgage security. It's a collateralized, secured mortgage that is also revolving, and what it'll display for a payment obligation on, depending on when credit's pulled, will be just the interest only payment. So a lot of lenders will approach it and just utilize the interest only payment that's, you know, documented on the credit report for, and also validated, confirmed through statements, use that interest payment for qualifying purposes on you know, additional financing. We certainly approach it that way, you know, knowing the product, having built it. That's how we approach it when we're qualifying for an additional all-in-one loan or something. We use the interest only payment from an existing one to help qualify for that. But I really can't talk to, I don't know, Jim or Katie, if you're familiar with other products and how they would look at the all-in-one loan payment obligation as it relates to qualifying for that other conventional mortgage.
I think you're right. I think it would be verifying with the most recent mortgage statement and in conjunction with what's reporting on the credit report. I guess somebody could take it a step further and ask for the promissory note, which might show the principal and interest portion of it. I don't know if the promissory note shows that, honestly.
No, it
Okay.
essentially, yeah, it doesn't.
Okay.
It's all based on the current daily, average daily principal balance on a monthly basis.
Yeah.
As way of disclosure, it certainly shows, worst case, right? And based on fictitious loan amount or loan balances,
Sure. Sure.
for disclosure purposes, that tends to confuse people.
Okay.
But yeah. But hopefully that answers the question. I think most lenders would probably look at it as an interest-only payment obligation as they approach qualifying for an, additional financing.
Okay.
Yeah. Okay. Thank you, Deb.
Welcome.
And
Yeah, thanks, Dehi. We can
Indeed.
talk to you
I
more
have an
about that
investment
too.
question for you, Dave.
Yeah, hit me, Becky.
Hey, what happens with the loans? Does CMG service them, or do they get packaged?
Great question. So we have built relationships over many decades with with multiple banks over time, but the two prominent banks that we use. So, let me back up one step. As we started to build this loan out, being an independent mortgage banker, we're not a deposit bank, of course, right? And so we created a problem for ourselves, which is, well, we can't service the account because we can't issue FDIC regulated deposit, the actual deposit or DDA, right? Demand deposit account, which is the processing of inflow and outflow of money. So we needed to partner with at least one bank or multiple banks in order to service the account as a sub-servicer. So our initial historically, I'll just give you a little background. Historically, our very first partner on the loan was GMAC Bank, Ally Bank, and they still service a large percentage of the portfolio. We also created relationships with Ameriprise Bank for their client base, and they love the loan. That's actually coincidentally why we peeled off the second brand name. We initially had it as the Home Ownership Accelerator Program. They licensed that for their own client base that they service, and so we continue to build out the program and spread geographically where we introduced it. And we established national relationships with Merchants Bank of Indiana, Merchants Bank Corp, out of Indianapolis, and North Point Bank out of Grand Rapids. National banks, they have brick and mortar footprint. I wouldn't say in every state or every corner. It's really virtual banking, but those are two predominant. Also a credit union that's in Northern California that focuses on the tech industry. Also is a approved servicer of ours for the product for only the tech industry in that region. But on a national scale, it's either Merchants Bank or North Point Bank. We also securitize the product. So where the loan asset goes, I think is also part of your question. We tend to keep it on our balance sheet and pool into securitizations. Or we also have an array of partners who love the asset on their balance sheet, the credit quality, the meaning of the product, the risk. And so they might buy it, portfolio, on their balance sheet for a while. They're also participants with our securitizations. So if they want to liquidate, they can sell the asset, but the servicing doesn't change. We're the master servicer. It's probably to the customer, that's the most important part of it. Who am I banking with, right? Is that going to change? Because we're all used to our loans being sold off, and that might also change the servicer, which is disruption completely. It's aggravating. On this loan, that doesn't occur. The servicing is placed with either Merchants Bank of Indiana. We decide that in underwriting, Merchants Bank of Indiana, or North Point Bank, and they're the sub-servicer on behalf of CMG Financial, CMG Home Loans as master servicer, and that banking relationship stays.
Wonderful.
Cool.
Good answer.
Thank you.
Thank you.
Yeah, of course.
All right. So finally, Jim DeMarco, he's just closed on an all-in-one, and he's going to share a little bit about why he got one and the closing process and what it looks like. He was telling me the other day he just got his debit card.
Yeah, well, it's Becky actually. It's a good segue into Becky's question and Dave's answer. And everybody's already shared great insight to Jennifer and Brian as far as the why the product works. So I'm not going to really go too far into that. I think once you see the light and it clicks, you realize, why wouldn't I get this loan? So that's more the realistic, revelation you get, especially as you start looking at how debt is leveraged and the flexibility you get with the product. I bought an investment property, so I did, go through the process of running the simulator, just like Jennifer's done, and it made total sense. I'm just putting all my rent in the product, factoring in annual taxes, factoring in annual insurance, maybe even property management fees, and I'm letting the money work for me. if I want to pull some money out for repairs in 3 years, you can run the simulator to reflect future expenses, which I think is brilliant. And the fact that Dave and his team has created a simulator calculator that predicts and can analyze future expenses, future withdrawals, very granular, very it gives us as clients the ability to really analyze, hey, what's going to happen in 2 years, 3 years. And for financial planning like Becky, it gives your clients the opportunity to evaluate future investments and all of that. So the simulator is just it gives you a lot of peace of mind going into it. And what's validated all of the product and the process and how well it's built out and established is, before you close your loan, you're going to get a call from CMG's all-in-one department. They're going to walk through all of your questions. They're going to go through all the numbers. They're going to make sure you understand the product. So they're going to give another quality call just to make sure you're comfortable and sort of what happens next. And to what Kathy just mentioned, I got a wonderful welcome letter after we close explaining, hey, congratulations. Here's what happens next. Here's what we'll do. Here's what you should do. Stay on the lookout. And then just literally 2 days ago, before Kathy reached out for this opportunity to be a part of this, I already got my debit card in the mail. It's got a nice all-in-one branded logo on it. It's Visa. It goes everywhere. I'm with North Point, Dave. So to your point, great. I mean, great website. I went in there and registered my all-in-one loan. I've got my online banking set up. I linked it to my existing Bank of America account. I've already moved some money over to it because I've got some money sitting around, and like we all do when you're checking your savings. That's just kind of like, hey, in case shit happens, right? Yeah. But you just move it into there, and then if you need it, you just pull it out. It's all synced up. It's all instant, same day. There's no cost, no fees. If anything, arguably the all-in-one account, the checking portion of it that's integrated with the loan, arguably it's actually more competitive than most of the banks we're working with today in terms of fees and accessibility, daily limits, all the great things you're going to want in a checking account, because these are truly, true banks, FDIC insured, they're reputable organizations. We just happen to partner with them, like Dave said, for the checking and liquidity portion of this product. Yeah. So all in all, guys, I mean, the why is there, and not just the why it works, but also the execution and getting it done. It's awesome. So, I mean, it just, anybody who's looking to investment or second homes, even your primary residence, it fits all the boxes. So
would you say, Jim, that the account and your as you navigate around, it's super clean, right? It's because I think a lot of times our banking, we're sort of, I don't know, I have this theory that is well, I'll say it this way, Americans are more likely to get a divorce than we are to change our banking relationship in the United States. And that's useless. It's a useless stat, but it's funny and it's telling, because I think people don't change their banking relationships, not necessarily because they're so loyal to their, to their bank. It has probably a lot more to do with the kind of the laborious, process of setting up your stuff. And there's no real tangible benefit to go do that, to change from this bank to that bank. And I think we get clouded too. I think a lot of checking account online platforms are so clouded with all these extra stuff, you get lost in it. You're like, oh my gosh, this full feature, I'll never use 98% of that. But, and you get lost in it. This is set up to be very clean, centered on the all-in-one loan. So checking account integrated with line of credit, it has meaning, has more meaning than a standard checking account, has more meaning than a standard HELOC, integrated together. So navigating around and just setting up your stuff is made easy that way. And then, of course, I love that you mentioned the extra diligence done right before closing, because if there's confusion and if there's, misalignment with understanding how to benefit from it, we pause on closing. We just won't do it. And that takes customer interaction, old school way. Picking up the phone. We don't close it without that conversation unfolding and without somebody saying, okay, I'm ready. I'm excited. Let's go. Yeah. So, I appreciate your comments.
Really refreshing. And, maybe there's a lot of us on the call that are a little bit older, but I think the newer generation, they may not be married to their checking and savings accounts as much as maybe we are. Yeah. So I think the fact that once you get on here and see how seamless and easy it is to use, it just makes sense, and it just depends on each person. But there's no reason why you can't shift all of your banking to North Point or Merchants Bank, because it's all there. It's all, you have bill pay. I can take the app on your phone. You can take a picture of your check if you want to deposit a check on your mobile service. It's very slick. It's seamless. It's easy. And it's instant, which is great, guys, because with this loan, it's designed to make sure you have access to your money in a two-way street. Another thing, guys, a lot of home equity loans, like if you go and get a traditional second mortgage, a lot of times access to that money is a lot harder. You have to actually get a wire transfer or set up some sort of like, you have to write a manual check. This is a much different product in a sense of how you access the money and how flexible and fluid it is, that I learned through the process is very different than any other, home equity out there. So it's great. And I love championing the product to my friends and family. And as soon as we can start doing more of them than just a couple, Dave, that's what we're shooting for. Like Brian's the guy, he's got 3. I was like, man, that's a good start. So looking forward to
Brian is a big advocate, actually. He's
it does create a conundrum, like Brian said, where it's the all-in-one loan, right? Not the all-in-3 or all-in 10. I'll tell you that where our mindset is, we are venturing down the path of doing diligence on the idea of cross collateralization with the product. So can you imagine if you wanted 3 and could benefit because you had enough cash flow to benefit from a product like this, instead of having to be forced to bifurcate income into 3 different checking accounts against 3 different debt instruments, having it all wrapped up into one, cross collateralized across a couple different 3 different properties, one account, one debt size. And that's exactly where other countries have pioneered the product into. It's you look at, I would encourage you even to look at, the way Canadian lenders and banks offer product. It's uniformed into one or universal account, which it just makes sense.
Is that coming?
Yeah.
Is
that something that's coming?
Yeah.
Is a process,
it's not, Jim. I can't make you a promise on a date, but we're headed down that path of analyzing legally, what that means and stuff. And cross collateralization is not a new thing, and the lending industry does that already. But on this loan, it has some other items we got to kind of go through. But hopefully in 2024, that's something we could initiate.
Well, you mentioned the Canadians. My wife's family's from the Philippines, and I showed this product to her dad, and he's like, "Oh yeah, we call that a back-to-back loan." Like you speak to other folks that are in developed countries, Australia, New Zealand. Yeah. This is how they finance homes. It just makes sense from a standpoint of you integrate where your money's coming and going, and that's what essentially a checking account is. Why not build it out to where that's where your financing for your home goes?
That's right.
So it's brilliant. Yeah. And like I said, my wife's father, he's like, "Can I do one?" And I started going down. I'm like, "I don't know," but he said, "This is exactly what I would do if I was financing a house here in the States."
Sure.
Yeah. That's cool.
Well, thanks.
Thanks you guys. I really appreciate it. I'm going to put one more screen up here, and for the attendees, if you want to take a minute and text me where you are on this list of people interested in the all-in-one, we'll send you a little token of our appreciation. Yeah, you sure can.
Take a picture.
And then Jim's and our team emails here on here as well. And so feel free to reach out to us with more questions. And like I said, many of you are first-time home buyers or still renting. We're happy to talk with you about other loans that we can do to help you get into a home as well, and couple them with the all-in-one if that works.
Indeed.
Is there any questions while you guys finish up?
There was one question on here. Let's see, from Andre Griffin's. Like to know more about down payment in depth. He got a late start into the meeting.
Okay.
No, yeah.
So Andre, we'll reach out to you separately, and we will invite you to a down payment assistance and down payment webinar as well in January, but we'll talk to you personally on that as well. So.
And then otherwise, it's just people really appreciating the information. Patrick Mines said he loves, or it's encouraging, and he hopes it's not too late in life.
I don't think he's, yeah.
No, I don't think it is. So happy to run a scenario or a calculator for you and show you what it might look like. And that's it, though. Everybody
That's it.
really appreciated all the information.
Yeah, I think that was great. Really appreciate
Guys.
everybody's time and attendance. And we'll, yeah, we're here if anything comes up, and we ran over, so I'll let everybody go. But thank you so much.
Yeah, thank
Thank
you
you,
all
guys.
for coming.
Take care.
Bye.
Bye-bye.